Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's October the 1st, 2018. And so we're now launching ourselves into the fourth quarter of 2018. Time for a video update. So on the slides that I've prepared, you'll see the one in front of you now is our legal disclaimer. After you've read that, the next slide is going to be our overview slide. It really just outlines the areas that we're going to talk about in terms of this video, and you can see their current market update, interest rate increases, US markets, a couple of words about them, areas of opportunity, some of the areas that really haven't been doing that well, but from the stock market perspective, but the businesses have been doing well, so there's opportunities, and then just a quick update on our research team. So let's jump right into it. On the next slide, we really talk about the movements year to date. So for the first 3 quarters of 2018, let's just look at what's been going on in terms of the broader market. So number one, new NAFTA. We have today what we're being told a finalized agreement between Canada, United States, and Mexico. The bottom line from what we've seen is it really doesn't change how we're investing in terms of our companies. It does bring a little bit more predictability and an end to these discussions, and so that's helpful. So hopefully there's more certainty for businesses. But the bigger issue from Canada's perspective will ultimately be our competitive tax rates and also the levels of regulations that are being leveled against companies. So that's much more important in the long term in terms of attracting capital and our ability to compete. So when we look at the agreement now, it's great that it's behind us, but not a lot of changes to where we're investing. So that's good. The other performance numbers that we've laid out there give you a sense of what's been going on in some of the key markets, as I said, year to date, so for the first 3 quarters of 2018. The Toronto market has done nothing. In fact, when you don't add in dividends, it's negative year to date. So the Toronto market has been really underperforming. The next market is the S&P 500. That's the US market. I think most investors, if you're following the news, realize that given the changes in regulations, taxes dropping in the United States, there's been a lot of money going back into the US, and that has rewarded the US capital markets. And so the capital markets in the US are up high single digits year to date, and even higher when you look at the technology index. As you look around the world, if you go down to the FTSE, that's the FTSE, the British index, you can see it's down 2%. The broader European market is down about 3%. The Hang Seng, which is the Hong Kong market, a lot of important global businesses trade on the Hong Kong market, it's down 7%. When you go over to the mainland in China and look at their markets, given the disputes going on and trade tensions between the United States and China, you can see those markets are actually off about 14% year to date, which is a large drop. And then in Japan, the Japanese market has actually bucked the trend. It's up a little bit, although the yen is off. So net, it really hasn't advanced too much if you price it in US dollars or even Canadian dollars. And then precious metals have been hit hard this year. And so you see gold down 8% year to date. Silver's actually down even more than that. And that's largely because of the strength of the US dollar. And as long as the US dollar strength, it's really hard for precious metals to make an advance against a strong US dollar. And then we can see here that the Canadian dollar vis-a-vis the US dollar is off about 2.6% year to date. But if you look at today, where we're up because of the settled negotiations apparently between Canada, the United States, and Mexico, we'd be off about 2% because we're up about 0.6% today. So not really a lot of movement in the Canadian dollar given all the hoopla and all of the information out there. So basically the story is US markets, US markets, US markets. And you can see that largely reflected in your own portfolios. Now on the next slide, I just want to talk a little bit about interest rates. Interest rates have been moving up fairly steadily in North America. Now, I mean, around the world, they're still pretty low, and we haven't seen the uptick in interest rates to the extent that we've seen in North America. So if you go to Europe, they're still very low. They're still printing money there. Japan, they're still very low. They're printing money in Japan, and so on. But if you look at the next slide, we look at these interest rate increases. What's happening is the difference between the 2-year and the 30-year is becoming very small. They call that a flattening of the yield curve. And so I've given you a few statistics here. Over the last 12 months, on the 2-year treasury, the 2-year bond, if you will, of the US government debt, it's actually up about 1.37%. That's 137 basis points. So it's almost doubled. But if you look at the 30-year treasury, the increase in interest rates is just 0.33% or 33 basis points. And you can see that the difference between the 2-year and the 30-year, the 2-year being 2.81% at the end of the third quarter, and the 30-year at 3.2 is very small. You're talking here about 39 basis points or 0.39%. When you consider you're buying a bond for 2 years or a bond for 30 years, you're only getting 0.39% more. It's really telling you, without getting into a lot of details, that the market is quite skeptical on the longer term bonds, that bond yields really can't go up too much without bringing on a recession in the economy. So that's what happens when you get a flattening yield curve. And so we want to be cautious, we want to be careful, because the bond market is telling us that yes, short-term rates are coming up, and they're going to continue to rise as best we can tell, according to the Federal Reserve. But long-term rates are actually quite stagnant, and that means there's going to be some tension going forward here in terms of businesses, valuations, and the overall economy. Okay, so on the next slide, we just highlight the fact that in terms of the Federal Reserve, which is the central bank in the United States, the most important central bank in the world, which really does set interest rates globally, they continue to raise rates. They just raised rates last month in September, so the rate now is around 2.25%. They expect to raise them once more this year, 3 times in 2019, and then once more in 2020. Now that's as best as they can tell. That would bring short-term rates up to about 3.25%, 3.5%, a year and a half out. So we'll see what happens here. But the point of going through this is to say, look, as interest rates come up, bonds really don't perform well, so fixed income's under pressure. And businesses that pay a large dividend, those stocks sometimes can be under pressure also. It's hard for them to advance. So infrastructure or real estate companies, a lot of them come under pressure, and the stocks become a little sloppy. But again, we look at that as an opportunity from an investment perspective. Now, in the next slide, what we highlight there is just a quick slide about the U.S. markets. We love U.S.-based companies. You know we have those in your portfolio, and some of the best companies in the world trade in the U.S., but they're not cheap. So we need to be very, very careful. This slide just points out that the normal range for the S&P 500, which is the big U.S. index, broad-based number of companies, usually trade about 14 to 16 times earnings. Currently, in 2018, with the earnings being targeted at about 162, the S&P is trading at about 18 to 19 times. Next year, based upon earnings forecasts that are reasonable, we're looking still at about a 16.5 times multiple. And so the point here is we want to be careful. And the market could easily come back in the U.S., and a lot's going to depend again on the earnings growth of companies and ability to deploy capital. So we want to be careful. That's the whole point of just pointing this out. Things aren't cheap. They're not ridiculously expensive if we're careful, but we just want to plod along and be very value conscious. On the next slide, I talk about areas of opportunity. Now, I'm having a little fun here. I put cannabis, and I think most people know we're not investing in cannabis stocks for 2 reasons. Number one, let's just see how that whole industry is going to pan out. I mean, there's still a lot of uncertainty. There's going to be winners and losers. It's highly speculative. But secondly, from an ethical perspective, we have serious reservations and reasons why we would not invest in the cannabis industry. And we can talk to people about that. But we have had calls about the cannabis industry. And I think most of our clients know that that's not an area from an ethical and moral perspective that we'd want to be investing, given that many of the products that are coming out of the cannabis industry will be very detrimental to our society and to our culture. And although clearly there'll be some products from a medical perspective that will be redeeming in value, the majority of the industry is being pushed forward from a recreational perspective. But there's other opportunities. Precious metals we've listed here. As we've already pointed out, silver and gold are weak. It is just beautiful what's happening in terms of the opportunities for the royalty companies, the finance companies. We own Franco-Nevada, Sandstorm, Royal Golds, Wheaton Precious Metals. These companies are growing their profits. They are looking at increasing interest rates, or I should say dividends, in many of their businesses, and they're able to deploy more capital when there is a difficult market, and that's exactly what we're looking for. So if silver and gold stay weak, that's fine for our companies. Yeah, they won't go up and they'll be volatile and they might come off a little bit, but that's when the best deals get inked. That's when they get prepared and ready for an eventual turn and massive upside, particularly in a down market. So they're a great hedge. And then the other area that we mentioned here on the slide is large dividend paying securities. Because interest rates have been coming up, large dividend paying stocks have been weaker, but the businesses continue to grow really well. So Brookfield Infrastructure, Brookfield Renewable, Choice Property, some of our real estate companies, all of these companies are actually growing, expanding, becoming more valuable, even though the stocks have been sort of sloppy or weak. And they pay great dividends, and those dividends are secure. So that's another great opportunity for us to continue to deploy capital and take advantage of the weakness in the market. And then we continue to be active in terms of our research and looking at a lot of companies. So as we finish this, the presentation here, the last slide, I just want to talk a little bit about our research team, just to let you know that both Jesse Vandermeer and Andrew Chang finished their CFA exam schedule. So they've both passed level 1, 2, and 3. They do have to have a little bit more time in terms of investment research in order to be granted the charter, but the tough stuff is now over with. They've passed all 3 levels in terms of their exams, and so within the next 12 to 18 months will be receiving their full CFA charters, which is a major, major accomplishment, and I'm really proud of the guys. And it's a privilege to be able to work with 2 exceptional research professionals. And so I just wanted to pass that along to you. And then the next item is that on this list here in terms of research, we continue to look at a record number of companies, talking to companies, researching companies, running numbers on companies, and so on. So again, we're finding some neat companies to invest in. You'll see the benefit of that over the next number of months and years as we add more businesses and maybe trim other businesses from the portfolio. So the last slide in terms of just this presentation, just to remind you, we expect the best, plan for the worst, and be prepared to be surprised. I think that's a great way of going about it. We invest and buy quality, value, keep some cash for a rainy day and for volatility in the marketplace, and maintain exposure to the precious metals. We love the fact that gold and silver are weak. This is wonderful because it gives us, again, another opportunity to continue to buy some of these great finance companies at really quite exceptionally low prices, which is fantastic. So anyway, there's our update for October 1st, 2018, and we'll try to get another update in the next 2 to 3 weeks, and then another one prior to Christmas, so a couple more before the end of the year. If you have any questions, please call, email, stop by the office. Thank you very much, and have a great day. Bye now.